Concerns about a U.S. slowdown sparked the sell-off this week. China has been dealing with these issues for some time, with the Shanghai Composite down 10% in the past 3 months. And new data today showed China's consumer prices jumped more than expected in July, rising 0.5 from a year ago, erasing to some extent fears of deflation. But my next guest says the Chinese economy is still in terrible shape. Marko Papic joins us now. He's chief strategist at BCA Research. Marko, it's good to see you, and bring us up to speed on these narratives in China, where it seems as though deflation is still a concern. What do you make of today's CPI number?
Well, there's not much to really cheer in the CPI number because most of it had to do with food inflation. And so if you strip out the food component, you actually find out that there was no real inflationary bump. Also, on top of that, our emerging market strategy here at BCA Research has pointed out that their own underlying data for predicting CPI remains pretty much mired in disinflation. And this is a real problem, Kelly, because that means that real rates are actually higher than nominal rates. And that's preventing many consumers and the private sector of the economy from leveraging up and using the opportunity of low interest rates to actually re-engage and create demand.
So you'd stay away from the market. Is that the bottom line? I mean, I think that's now so consensus. I can't imagine anyone being excited to start nibbling away at Chinese stocks.
It's very difficult to see a catalyst. Policymakers have to realize that despite low interest rates in nominal terms, there is absolutely no appetite for borrowing. So this is very, very similar to 2010, 11, 12, 13, 14 environment in the United States and much of the West. China is stuck in secular stagnation. We can repeat all this verbiage from our own experience. And until policymakers in China realize this and catalyze much greater fiscal response, I don't think anything positive is going to happen.
And we've waited for years for them to do that. It doesn't seem like it's coming. You said, by the way, if anyone's out there holding Chinese corporate debt, that could be the next shoe to drop because spreads are too tight. What about the election coming up? Trump's odds have fallen precipitously over the past month or so, where it looked like he might be a shoo-in, and that would have bigger ramifications. Any thoughts on what a Harris presidency would mean?
Well, I would argue that ironically, and probably this is not a consensus, but I think Harris would be far worse for performance of Chinese assets than Donald Trump. And this is because I think that a President Harris would continue President Biden's policies, which have been to actually deepen the trade war with China and to really tighten the screws on some of the export controls. With President Trump, there is this non-linear outcome that is possible, which is that he actually gets a trade deal with China. Note that in his convention speech, he only used the word tariff twice. And both times it was to argue that he would actually force China to build factories, EV factories in the Midwest of the United States. Nobody really talks about this, but if that were to happen, it would mean a pretty significant trade deal between US and China. So in a way, Trump could become a catalyst after a 6 to 12 month period of brinkmanship for actual upside to Chinese assets. And I don't think that's really priced in or even talked about.
That's really interesting, although I can't imagine that. So I take your point that if he tried to force them to build EV factories in the Midwest, which is maybe a great idea that others will steal, that China would agree to that because it's part of a broader trade deal that would benefit them. But what would the U.S. get from that if we were to say, okay, yes, we get jobs in the near term, we get production here in the near term, but do you think his goal is something that would unlock better performance of China more broadly? Just unpack that a little bit.
Well, it's definitely not his goal. That is an ancillary outcome of his goal, which is to get good jobs, manufacturing jobs back in the Midwest, and likely crack open China, particularly in the services industry side, which China has stubbornly kept non-tariff barriers to trade pretty high. So obviously, it would benefit American corporations as well that mainly export services, and it would benefit the return on investment of Chinese potentially manufacturing firms that get to trade and export or rather build in the US, but then acquire those profits and return them to China. So in a way, it would be a win-win for the multinational corporations side of the ledger on both countries, but also for the workers in the US. But certainly it's not his goal to create a rally in Chinese assets, but that is what it would lead to. Also, remember, he seems to be comfortable with a weak dollar. Now, how we get there, that's a complicated story. But if that does happen, generally speaking, if the dollar enters a bear market for a number of reasons, of which one may be politics or monetary policy under Trump, that should also be good for emerging market assets, including China.